Good day. Today we are going to focus on um, the term consumable stores on hand. Okay, so first thing first, what are consumable? Consumable here we are talking about the goods in a business, the goods in a business that it uses to operate. So these are the goods in the business that the business uses. Okay, those are the consumable stores. So it can be a stationery, it can be a cleaning material, it can be a fuel, it can be a packing material. So if you can see all these goods, these are the consumable goods because the business uses these goods, right? So these are the expenses at the time of purchase. So meaning that when the business buys these goods, at that time when the business buys them, they are regarded as an expense. So meaning that at that time when the business buys these items, the expenses. So we know that the expense increase on the debit side, the account, the T account, right? So the expenses, they increase on the debit side and decrease on the credit side. So what are they saying? They are saying that at the time when the business buys these goods, they are regarded as an expense. So meaning that when the business buys these goods, the expenses, they increase. So we know that they increase on the debit side. Okay. However, at the end of the financial year, there may be some items that are unused. Okay, so the business can buy a stationery. Okay, the business can buy a stationery at the beginning of the year. So we know that it will be regarded as an expense at that time. But then now what happens when at the end of the year there is a stationery that is remaining that was not used? So in that case, we cannot regard that as stationery as an expense. Why? Listen to this. We need to come to the term which is called um, we need to come to the term that is called an asset. What is an asset? So an asset is anything that is in a business that can be turned into money. That is an asset. So anything that is in a business that can be turned into money or it is already money. For example, the bank. So the bank is already the money, so it's an asset. So anything in the business that can be turned into money, we regard that as an asset. So once we have a stationery that is unused, we cannot regard it as an expense because now it's unused, meaning that the business can sell the stationery and get money. So that stationery, it is no longer an expense, it is now an asset. Remember the unused one. Okay, so what does this mean? This will mean that now we need to go to the expenses account and decrease them with the unused because this is no longer an expense. So we need to take it out from the expenses and then go and put it in the asset account. So meaning that we need to decrease the expense and then come, this is your asset, and then come and increase your asset account like this. Okay, so there may be some items that are unused and cannot be regarded as an expense. So that is what they are saying. But as a temporal asset. So we regard the unused as a temporal asset. Okay. Um, consumable stores on hand has two elements. So we have the asset account and then we have the expense account. Okay. So once we found out that maybe a stationery or a cleaning material or a fuel it's unused. Once we found out that it is unused, so what we need to do is we need to transfer it to the um, asset account. Okay. Now let's look at the example. Let's look at the example. Let's look at the example. Okay. On 28 February 2011, okay, the accounted period footings total appeared in the general ledger of MN Traders. So this is a general ledger, the picking material. Let me open the picking material account. So the picking material, this is a picking material, right? So we know that the picking material is an expense, so it increases on the debit side. So the picking material is how much it is, 12,400. So this is a total. This is a total of the picking materials. This is the balance brought forward. So this is the balance of the picking material. It is 12,400, right? And then we also have, remember, the reason you are putting this 12,400 on the debit side, it is because the picking material is an expense. So the expense must have the balance on the debit side. And then we have a stationery. Stationery. So the stationery is also an expense, increase on the debit and decrease on the credits. So these are the expenses, right? These are the expenses. Okay. So how much is the stationery? It is 15,400, right? This is a total for the stationery. Total. This is a balance brought forward. So this is a balance of the stationery. Okay. Now, what are they saying in the information adjustment? On 28 February 2011, a physical stock count. Now, what is a physical stock count? A physical stock count, it is when the business is counting the stock of the business one by one, meaning that they count an item one by one, they check. Okay, so they are counting one by one. Okay, so on 28 February 2011, a physical stock count revealed the following that were on hand. So if they are saying that they were on hand, it means that these are unused items. Okay, it means that these are the unused items because they are on hand. So on hand, it means that these are the unused items. Okay, we have a packing material, which is how much? Which is 1,400. Okay, and then we have a stationary unused again, which is 2,400. So because these are the unused items, we can no longer regard them as the expenses. We must regard them as the asset because these are the unused items. Remember, I said that the asset, it is anything that can be turned into cash. So this is the end of the year, and then now we see that the stationery and the packing material, they are unused. So because they are unused, so they are no longer an expense, they are now an asset. Okay, so this means that now we are going to have a packing material. Okay, we are going to have two packing material account, but the difference is that now this packing material, it's an asset. Okay, the difference is that this packing material, it's an asset. So we know that the asset increase on the debit and decrease on the credit side. Okay, so remember, um, I said that after uh, you found out that we have the unused items, they are no longer, okay, they are no longer expenses, they are now the asset. Okay, they are now the asset. So the asset increase on the debit and decrease on the credit side. So now what we need to do now is, because now we know that this packing material of 1,400 is no longer an expense. So what we need to do is we need to come to the packing material and decrease it by 1,400 to show that the expenses, they are decreasing. Why? Because this sorry, it's a 12,400. Okay, we write the 12,400 on the credit side. Oh, what am I doing, Ivan? Okay, it's 1,400. I'm making a mistake. Okay, so what I'm saying is that once we see that we have a the consumable items that are on hand or that are unused, so what we need to do is we need to come to the expense account and decrease it. Okay, now let's look at this. The packing material, the total of the packing material, it is 12,400. It's an expense because above we learned that when the business is buying the consumable items, it regards them as the expenses. Okay, but once at the end of the year, the business found out that we have an unused. That unused, we cannot regard it as an expense, so we must regard it as a temporal asset. So what we need to do is we need to transfer that amount to the asset account. So to transfer that amount to the asset account, we must decrease the expense. Okay, so now we are here to decrease the packing material with 1,400. Okay, we are decreasing it with which account? With the packing material. With the packing material, but the one that is an asset. Okay, so what do we know? The double entry system, it is saying that if something is debited, I mean, if something is credited, it must also be debited. Beside that, beside that, we are told that if we have an unused consumables, which is a packing material, fuel, stationery, there are many. Okay, so we need to transfer it. I mean, we must regard the unused as the asset. So now we are transferring this 1.4 to the asset account. So the journal here, it is a GJ, and then now it is coming from where? It is coming from the packing material. It is coming from the packing material. It is coming from the packing material, the one that is an expense. So let us write E here. The one that is an expense. Okay, packing material GJ is 1,400. So therefore, we have decreased the packing material. Now let's go to the stationery. Stationery is how much? It is 2,400 on hand, meaning that's the unused stationery. What do we know? We know that if we have an unused consumable items, we must come and decrease the expenses, right? So now we come to the expense of stationery, we decrease it by 2,400, right? That generally it is GJ. Now we are transferring this amount of 2,400 to where? To the stationery, right? The only difference is that we are transferring it to the stationery, which is an asset, right? We are transferring it to the stationery, which is the asset. Remember, it's a temporal asset. So we come and increase the asset with 2,400 to show that the asset they are increasing with a 2,400. So this is coming from the stationery, which is an expense. So we are done with our consumables. We just have to do it like this. Okay, thank you so much.